Masha Limited is what is a manufacturing company that prepares financial statements in compliance with IFRS and has a reporting date to 31st December. During the year to 31st December 2022, Masha entered into a contract with a customer to manufacture and sell some goods, such that goods will be delivered. Control of the goods vests with the customer in 2 years. The contract has two payment options. The customer can pay 500,000 when the contract is signed, or 650,000 in 2 years when the customer gains control of the goods. Masha incremental borrowing rate is 10%. The customer paid 500,000 on 1st January 2020 when the contract was signed. Masha intends to recognize revenue on this contract in the financial statement. Required. In accordance with IFRS 15, revenue from contract with customers. Explain with supporting calculation how Masha should account for the above transaction for 2020 and 2021. Let me explain this. So all that this is talking about is that Masha is a company that prepares its financial date to 31st December. In December 2022, Masha enters a contract with a customer to manufacture and sell some goods. That's the goods will be delivered. In the right control of the goods vests with the customer in 2 years. What they want to mean is that they will manufacture the goods and deliver to the customer in 2 years' time. The contract has two payment options. First option is that the customer can pay 500,000 when the contract is signed. It means pay the money when the contract is signed, but you will receive the goods when 2 years' time. That's the meaning. 2, 650,000 in 2 years' time when customer gains control of the goods. They are giving them two options. Either to agree in advance payment, or you agree in the instance where you receive the goods and you make payment. Third paragraph says that Masha incremental borrowing rate is 10%. The customer paid. So clearly the customer has opted for the option 1. The customer paid 500,000 on 1st January 2020 when the contract was signed. Masha intends to recognize revenue on this contract in the financial statement. So clearly, the customer has agreed to pay in advance and receive the goods in 2 years' time. So when you are confronted with this question under IFRS 15, how do you recognize revenue? What is the name of the company? The company's name is Masha Limited. This arrangement is contract. It falls under this contract assets and liability, and this one falls under under contract liability. All right, so it falls under contract liability, and I call it advance payments. What are they supplying to what are they supplying? They are supplying them goods, right? They are supplying them goods. So please, when you receive a question like this under IFRS 15, the first thing I will admonish you is that you mention the five step model of revenue. First, you say that identify the contract with customer. 2, identify the performance obligation. 3, determine transaction price. 4, allocate the transaction price to performance obligation. And then the 5th one, recognize revenue when performance obligation or obligations are satisfied. Okay, so these are the 5 models. So after you are done then you can what? You can start the solution. So now you have what? You have what? You say what? The contract sum is how much? 500,000. The question. Contract or delivery term of what? Delivery of goods. 2 years time. Cost of what? Cost of what? Capital is 10%. All of them are in the what? In the question. You can see it there. All of them are in the question. So you can see it there. Okay, so once we satisfied ourselves here, then how do we what? How do we solve this? So you have all this. So here you come here and say you'll bring your what? Your principal. You'll bring your what? Your interest here. Then you have your what? Your principal plus what? Plus your interest here. Now I'll explain this. Now, when you are what? When you receive, well, when you look at this very contract, the company has received what? The customer's money in advance to deliver goods to what? To deliver goods to what? To the customer in 2 years' time. In this arrangement under IFRS 15, when you receive money in advance, it is like you went to what? You went to a bank or you walked to a bank to take a loan. That is the principle. So when you receive a customer's money in advance, that money doesn't belong to you. So that money will attract interest every year. That's what you should put it at the back of your mind. That money will attract interest every year. Unless maybe if the contract is just 1 year, you realize that the maybe if you took a contract on 1st January 2020 and you are delivering the goods on what? 31st December 2020, this contract will not sit in your book. It's just within one accounting year. So there's no need for you to what? Charge any interest that will sit in your book. But if it is a contract that goes beyond one accounting year, then this is the process that you what? This is how you go about it. One, you will pick, this is your what? Your number of years. So you will pick year 1. How much did you receive? How much money did you receive from the customer? You receive 500,000 to deliver goods. And you will charge what? 10% of that. So when you charge 10% of that, how much is it? 10% on 500 will give you what? 5,000 or 50,000, right? So when you are done, then you add the what? You add the 500,000, the principal money and what? And the interest together. So that gives principal plus interest. That gives you how much? 550,000. Is that correct, please?
Yes, sir.
So that gives you 550,000. Now, when you come to year 2, you carry this 550,000 here. Then you charge 10% on this 550,000. That gives you what? That gives you what? 55,000, right? Then you add this one and this one. What do you have? When you add the two, what do you have?
605,000.
605,000. Okay, so you are done. So this is what you will do. So when you are done, then you can now do your profit and loss extract. So you will have what? Years. You have year 1, year 2. So you will have what? The interest that you calculated. The interest year 1, the interest is how much? 50,000. Year 2 is what? 55,000. Then you will come towards your statement of what? Financial position extract. Year 1, year 2. The money doesn't belong to you. So we call it what? Contract liability. So you come here. You come under your what? Under your liabilities. You have what? Contracts. So the contracts, the principal amount that you have there. So the first one is what? 550,000. And the second one is what? 305,000. So this is how you will report it at the end of what? At the end of the period. At the end of the day, when you deduct the interest from the liability, it will equivalent to what? The same amount of what? 500,000 at the end of the year. So that is how we report under the advance payment.